The stock market's been a little choppy so far in the third quarter, but we're still up nicely for the year. How will the rest of the year play out, and how do things look for 2025 given recent changes in central bank policy, imminent presidential elections, new innovations in technology, and various geopolitical factors? Hello and welcome to the Cedar River Capital Market Touchstones slideshow update for the third quarter to date of 2024. The date today is September 22nd, 2024, and today we'll be discussing these and other factors driving the stock and bond markets. My name is Paul Latta. I'll be doing the speaking today, but my business partner Baj Kochar and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. We'll begin today with the discussion about the recent market action, then we'll look at the macroeconomy to put some backing behind the market discussion, and then we'll move to a microeconomic view and look at key industry-specific drivers, and then we'll conclude with some longer-term observations about the investment landscape. The S&P 500 has done well over the last year as well as over the last 5 years. The trend has not been straight up, of course. There have been dips along the way. Indeed, the present third quarter has seen more volatility, as you can see on the chart on the left. But we are up 28% in the last year as of September 18th, and we're up 103.6% over the prior 5 years. The bond market has been reasonably strong in the last year, up 10.1%. Much of that return has come in the third quarter in anticipation of the Fed's first rate cut in 4 years, a rate cut which happened just this past week. The recent rally in the bond market puts the 5-year return at a fairly small 2.4%. Seems the bond market is still not back up to its record highs set in 2020 and 2021. With more Fed rate cuts likely, the tailwind of the bond market is likely to continue. This is a long-term view of Fed policy going back to 1970. While rates were higher in the inflationary era of the 1970s and early 1980s, Fed funds rates in the last couple of years have been at 20-plus year highs. On the far right, you can see the Fed just cut rates 0.5% after holding rates constant and at an elevated level for about a little over 2 years. More rate cuts are likely in coming months, as we'll discuss on the next slide. This is the Fed Watch tool from the Chicago Mercantile Exchange, which is showing the implied probability of rate cuts at subsequent Fed meetings. Most likely is another quarter-point cut at the November meeting, as shown in the blue square at the top right. And in the December meeting in the next line, the blue square is landing on another half-point cut for December. Additional rate cuts are expected at subsequent meetings into 2025, as shown in each of the blue squares. These implied probabilities are slightly more dovish than the Fed's internal projection, which is showing a slightly slower rate of rate cutting. These rate cut probabilities, of course, are a moving target, and they do change every day based on commentary from the Fed as well as economic data such as the Consumer Price Index, unemployment, and much, much more. Most central banks in Europe and North America are now in rate-cutting mode. The U.S. Federal Reserve seems to be one of the last major central banks to join the party. Those areas seeing economic weakness have been leading the herd. That is the case with most of Europe. China is also in rate-cutting mode, though China is a special case since it never really experienced the COVID-era inflation, and weakness is more structural rather than cyclical at this point. There are a few central banks around the world that are not cutting rates, and even a couple that are raising rates. There are two common explanations for not following the herd at this point. Either inflation has not eased enough to warrant rate cuts, like South Korea, India, Australia, or currency softness is mandating a more hawkish policy to defend the currency, like Brazil and Japan. This chart plots the spread between the 2- and 10-year Treasury yields over the last 30 years. The 10-2 spread is the most common measure of steepness of the yield curve. And a negative spread, also known as a yield curve inversion, does not happen very often, as you can see in the chart. But economists watch closely for yield curve inversions, since every yield curve inversion over the last 35 years has seen a recession occur within 1 to 2 years thereafter. We've been in a deep yield curve inversion since mid-2022, the deepest inversion in almost 40 years. But with the Fed rate cut this past week, the yield curve inversion has all but disappeared. As shown here, the spread is now a positive 9 basis points. Does that mean the recession risk has disappeared? Alas, no. As you can see on the chart, recessions did not occur when the yield curve was inverted. Rather, the recessions occurred within a handful of months after the yield curve stopped being inverted. Bears have been especially cautious here, since the only thing worse than going into a yield curve inversion is coming out of a yield curve inversion. Bulls, in contrast, would look a little closer at prior down cycle. down cycles and note that most recent prior down cycles reflected bursting bubbles, subprime real estate and dot-coms in particular, and that this cycle does not appear to have the same structure, being mainly driven by post-COVID inflation, that is, constrained supply chains amid COVID recovery. So a broad-based bubble-popping recession does not seem to be in the cards the way it was in the 2000 dot-com bubble or the 2008 real estate bubble. Bears would dispute the idea that we're not in a bubble. After all, we've seen the enormous lift in FanMag stocks driven by the generative artificial intelligence story in ChatGPT. Well over $1 trillion has been driven into the FanMags over the last 2 years. Bulls, however, would point out that unlike the dot-com bubble, the moves in Gen AI stocks like NVIDIA are actually supported by real revenue and real earnings gains. So NVIDIA here at 25 times next year's EBITDA consensus, well, that's justifiable compared to Pets.com in 1999 at over 100 times sales, a ridiculous valuation. If this is a bubble, it's a bubble in earnings, not a bubble in stock valuations. Naturally, our read is somewhere in between the bulls and the bears. We believe there is indeed a vulnerability to slowdown, especially in the 2025 post-election timeframe. In our view, vulnerability to a bursting bubble is small, but not zero when compared to prior recessions. And the Fed rate cuts, well, they're actually going to help address any such slowdown. This chart looks a little bit more into the bearish point of view about rate cuts. Our friends at Strategas show here on the chart on the left that on average there are 100 trading days between the last rate hike and the first rate cut, and the S&P 500 gains about 5% during that time. But on the chart on the right, we see that the market actually sells off after rate cuts start, and that the market bottom is about 213 days after the first rate cut, and during that period of time the market declines 23.3% on average. Another way to think about this chart is that the Fed is cutting rates for a reason. Typically that is, well, an ugly recession threat, and in recent decades that recession threat was driven by bursting bubbles, the real estate bubble or dot-com bubbles. Such bursting bubbles have indeed been bad for stocks. The present rate cutting by the Fed does not seem to be driven by a fear of a bursting bubble. That said, there are signs of softness with weakness in auto sales, transportation services, temporary help. We'll talk a little bit more about the economy beginning on slide 18. Back to the stock market now, and the key factors driving investment there is shown here. We've already discussed interest rates, but let's look at these other factors too. Let's begin with valuation. Market valuation is modestly above the middle of its historic range. This chart shows the last 10 years of the S&P 500 in blue and the PE ratio of the S&P 500 in purple. As you can see, the S&P gained 236% over the last 10 years. In purple, you can see the price-to-earnings ratio has ranged from 14 times up to 24 times over the last 10 years and is presently at 21.2 times, which is on the high side but still within its historic range. This chart compares the earnings yield of the S&P 500 to the yield on the benchmark 10-year Treasury bond. The earnings yield is the upside-down PE ratio, the E to P ratio, if you will. Whichever line is higher is the better value with this approach. As you can see, stocks remain the better value, but the higher rate environment over the past 2 years has narrowed the lead considerably. Of course, the Fed rate cut last week seems to be moving bonds back the other direction. While we would prefer buying bonds where they were 3 to 6 months ago, we believe bonds are still compelling at these prices. Of course, Federal Reserve rate cuts at subsequent Fed meetings suggest bonds will become less compelling over the next 12 months. That does provide some motivation to act now with appropriate allocations to bond portfolios. Money on the sidelines has indeed increased, as you can see in the white line on the chart here. We now have retail money market funds well over $6 trillion. Higher rates have been the key driver. Certainly higher rates are more attractive to savers. But also with the yield curve inversion and related recession threat, cash is a safer vehicle than nearly all other asset classes. Eventually rates will decline, as we discussed back on slide 6. In past periods of peak cash levels like 2008, 2003, and 1991, the stock market rallied quite strong in subsequent years. But this peak may be different. Indeed, when looking at cash as a percentage of the S&P 500 market valuation, as shown in the line in blue, the cash stockpile is much smaller than what we've seen in the past. Our read here is that the Fed rate cuts will still be constructive for stocks, but not quite the tailwind that we've seen in prior cycles. Returns by sector in the third quarter are very different from what we've seen in the prior 2 quarters. Recall in the first half of the year, approximately 2/3 of the gain of the S&P 500 came from the 6 big tech stocks, also known as the FanMag stocks. FanMag is an acronym for Facebook, Amazon, NVIDIA, Microsoft, Apple, and Google. And nearly half of that big gain from the fan mags was due to just one stock, Nvidia, which had a powerful performance in the first half of this year. All 6 names were strong gainers on the generative AI theme. But the third quarter has seen a bit of a reversion on the Gen AI theme. The leaders in Q3 so far have been defensive, income-oriented names like utilities and real estate companies, or the REITs. Seems the dovish move by the Fed has stimulated the appetite for bond alternatives in the stock market. For the year to date, the fan mags are still ahead by a fairly wide margin, but their lead has narrowed quite a bit. As we mentioned back on slide 3, the third quarter stock market experienced quite a bit more volatility than we've seen in recent years. Indeed, the VIX volatility index hit a 4-year high in August, as shown in the chart here. The cause of the huge volatility spike was the surprise rate increase by the Bank of Japan, ostensibly due to a combination of, quote, inflation, wage growth, and a weaker yen, unquote. Rate hikes from the Bank of Japan are rare indeed, with the country being under a deflationary threat since the Japan bubble burst in 1990. So the shock and surprise to the global capital markets was sizable, with a 20% drop in the Nikkei and a 12% drop in the U.S. NASDAQ within less than a week. Some investors were surprised to see U.S. stocks impacted so significantly to a development in Japan. Alas, our custodian, Interactive Brokers, has been publishing warnings as far back as May and June of this year about the tight correlation between the weakening yen and the strengthening fan mag complex. The yen carry trade, shorting yen to buy U.S. stocks, has been around for at least 30 years. But what was unusual this time was that the proceeds were not targeting the overall S&P 500, but specifically the fan mags. And since the Bank of Japan spoiled the party with a rate increase, the fan mags have yet to regain traction. The style factor breakdown year-to-date also reflects the impact of the fan mag moves. That is, fan mags were strong in the first half of the year and weak in the third quarter to date. Income stocks have been strong in the third quarter, so far thanks to the Fed rate cuts. But the leading style in Q3 was the low volatility style, clearly a reaction to the large spike in volatility in August. Interesting. The U.S. market outperformed essentially all other developed markets in 2024, as shown in the table here. However, most of that return has been due to the fan mag stocks, especially in the first half of the year. In contrast, the S&P 500 equal weighted index, which does not assign higher weights to the fan mags, shows a more representative gain of 13.8%, which is still above most other regions but closer to the middle. India's stock market is right behind the U.S. market. India continues to see tailwinds as an alternative to China amid strong U.S. reshoring efforts. Latin America stock markets have been under pressure, mainly related to currency softness and the related pressure to raise rates. Mexico is seeing yet additional pressure, mainly on immigration pressure amid U.S. presidential elections, and also due to fears of judicial reform under new President Claudia Sheinbaum. We'd now like to move on to part 2 of our slideshow today, the economy. We'll begin with looking at GDP levels by country. Most regions of the world are showing positive growth. There are select weak patches, mainly in Northern Europe, like Sweden and Germany, and in Asia, like South Korea and China. But there are no major economies in recession at this time. Also, there are fewer weak patches than we saw in 2023, where you can see more red on the table here. So 2024 seems to be moving forward for most of the world, and with only a few weak patches here and there. This chart gives a nice visual view of the GDP forecast for most regions of the world using the GDP forecast from the International Monetary Fund. As you can see, there's very little red in the forecast. Most everywhere is green. IMF forecasts seem to conclude that the already weak regions will not really boom before year-end, so Sweden and Germany in particular will remain positive but weak. China will also remain weak, though we should say weak for China. That is, the 4.6% projected GDP growth for China, well, that's about half the normal growth rate for China. Where is the economy headed? Our read is that the strengths listed on the left will modestly outweigh the weaknesses shown on the right through the balance of 2024. However, there may be some post-election softness in the economy in 2025. To look at just a couple of these line items, the labor markets seem to be a key indicator. Yes, payrolls remain positive, jobless claims are low, and layoff trackers are not really in the headlines. That said, jobless claims are lifting, unemployment is creeping higher, and the temporary help index, a leading indicator, is actually falling fairly persistently. The labor market, in other words, is doing okay, but with signs of deterioration. Services businesses seem to be holding up well, but manufacturing businesses are slowing. This can be seen by comparing the PMI services to the PMI manufacturing metrics. It can also be seen by comparing earnings in IT services, which are largely healthy, versus earnings in the automotive sector, which seem to be in free fall. Also, as we've discussed, bulls interpret Fed rate cuts differently than bears. Bulls believe rate cuts are a relief and a lower cost of capital for all, which is true. Bears do not disagree, but highlight that the Fed is cutting rates for a reason, and the recessions are at the top of the list of reasons. Again, our read here is that 2024 will finish positive, though there may be some post-election softness in 2025. Inflation is moderating in most countries, as you can see here, but not at the same rate. Notably, 2 countries have reached the magical target 2.0% inflation rate, Canada and South Korea. But most other regions are closing in on 2%, but not quite there yet. That includes the US. There are 2 outliers, China on the low side at 0.6% inflation, that's mainly due to the economic weakness there, and Russia on the high side at 9.1%, mainly due to the war in Ukraine. US headline inflation of 2.5% is just a tiny bit above the target of 2.0%. The stickiest part of inflation remains shelter, which is essentially rent or owner equivalent rent. Shelter cost inflation in August was 5.2%, an uptick from the 5.0% in July. Shelter is a big component of the Consumer Price Index. If shelter were excluded from the CPI would be 1.0%, which is well below the 2.0% target. This is an election year, of course, so there's always the question of how the stock market performs during election years. This chart shows that there's really not that much difference between election year performance versus non-election year performance. And that holds true when one looks at either the average returns or the median returns. While the presidential elections dominate media headlines, the stock market is about much more than who is president. It's also about Federal Reserve policy, new advances in artificial intelligence, new breakthroughs in weight loss medicines, geopolitical developments in the Middle East, fashion changes, and much more. We've used this slide in prior slideshows. This is a curated consensus on what sectors are commonly mentioned as beneficiaries of either a Democrat or Republican presidency. As you can see, consensus beneficiaries for the Democrats are big tech, renewables, electric vehicles, media, Mexico. For Republicans, it's big oil, banks, materials, trucking, firearms, and Russia, the Russia bias mainly being an oil bias. And there are issues that are increasingly seen as bipartisan. The anti-China stance seemed to have started as a Republican bias, but now seems embraced by both parties. Defense was historically a Republican bias, but the Ukraine conflict seems to be driven more by Democrats, and Republicans are distancing themselves from the conflict using budget overruns as a rationale. Lastly, anti-immigration seems to be a Republican stance, but Democrats have made a few small steps in the same direction in recent months. Here we see sector performance in presidential election years going back to 1976. Seems the main observation here is that there are very few patterns over the years. While there are several reasons for this lack of consistency, our favorite reason is that the stock market is about more than who is president. As we discussed in the slide 2 slides ago, the stock market's also about things like, well, the Fed interest rate policy, new advances in artificial intelligence, new breakthroughs in weight loss medications, geopolitical developments in the Middle East, and much, much more. With the big spike in volatility last month related to the surprise Bank of Japan rate increase, it seems to make sense to also look at the history of volatility around presidential elections. Vanguard put this chart together and concludes that markets tend to ignore the results of presidential elections. Certainly we saw a lift in volatility around the 2008 election, but that was also overlapping with the collapse of Lehman Brothers amid the subprime mortgage crisis. Most other elections have seen virtually no change in volatility around elections. Elections are important, but the stock market is about more than just the elections. We'd now like to move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. We'd like to highlight 5 industry discussion topics. First, are SaaS stocks oversold? Second, is this the time for income stocks? Third, what do staffing stocks say about the economy? 4, has Intel lost its mojo? And then lastly, number 5, will oil prices continue to soften? The Software Equity Group, SEG, puts together a representative index of SaaS stocks, or software as a service stocks. And the SaaS index has been underperforming the market by a fairly wide margin so far this year. There are some really good businesses within the SaaS space. Why the weakness? Well, there's a combination of factors as listed here. To begin with, SaaS stocks as a group have done well in prior years, so some consolidation in the present year may make sense and allow fundamentals to catch up with valuations, or perhaps valuations to reconnect with fundamentals. Also, most SaaS stocks are in the tech sector, and the lift in artificial intelligence stocks has not exactly been a broad-based move. Many SaaS stocks have been left out of the AI rally. The SaaS space is fairly large, of course, with over 100 publicly traded companies. That is a crowded space where standing out from the crowd is increasingly challenging. Lastly, there have been patches of weakness at select SaaS companies, including several of the higher quality leaders. Only 12 of the top 50 SaaS stocks are beating the market year to date. Is there anything in common with these names? Well, not much as it turns out. What we really have here is a classic momentum investing situation. That is, those companies that show persistent quarterly upward guidance revisions continue to attract momentum investors. This style is known as frog in the pan investing. More telling is what the leading companies do not have in common. Valuation is actually all over the place, ranging from 4 times sales up to 21 times sales. And SaaS subsectors are also all over the place within the leadership, including customer relationship management, CRM, security analysis, domain registration, data analytics, industry verticals, etc. The challenge with this frog in the pan momentum investing is that it works so well in the short term, but backfires profoundly when it stops working. Indeed, several of the underperformers from the past 12 months were actually outperformers a year ago when something went wrong and upset the momentum. Most SaaS stocks are growth stocks, and value investors are not very well represented. Still, some measure of value seems appropriate in order to avoid getting caught up in the momentum machine of ignorance that buys into upward sloping charts with no regard for what a company does, who runs the company, or what might be considered fair value. For SaaS companies, we prefer using an enterprise to EBITDA plus R&D as a valuation metric, which we use on the next slide. This chart shows that faster-growing SaaS companies trade at more elevated valuations, as expected. That is, the regression line is upwardly sloping. But there is a fairly wide variance around the regression line. Also, the regression line is not constant. A year ago, the regression line was quite a bit steeper than the regression line today. From a valuation perspective, it is generally preferred to buy names below the regression line. Of course, names that are too far away from the regression line are usually there for a reason. Most likely a change in the growth projection is imminent, or there was a very recent change in the growth projection and the analysts have simply not updated their projections yet. One should never buy or sell a stock on valuation alone. This chart shows the features we believe important in a good SaaS stock investment. At the top of the list, we believe, is monopoly power. This is the most sought-after feature. Usually, monopoly power is a feature of switching costs being prohibitive. That is, once you've started to build out your system based on a certain SaaS provider, it becomes virtually impossible to switch to an alternative SaaS provider. The Microsoft Core operating system is a textbook example, though the same could be said for CRM, customer relationship management data, or Oracle databases. Other features to look for include a sizable market, consistent earnings guidance, a chart that is not overbought, and of course, valuation being reasonable relative to growth. While there are a number of SaaS names to choose from, this table shows a handful of names that screen well from our perspective. It seems there are no names that are phenomenal growers with huge markets trading at rock bottom prices, of course. Stock selection is a process of weighing the trade-offs. Some of these names are cheaper than others, like Salesforce and Block. Others are fast growers, like Palantir, and some are special situations, like Qualys and SPS Commerce. Changing subjects over to the income stocks, as we discussed back on slide 14, the income stocks have done quite well, mainly due to the increased attractiveness of income stocks with the Fed in rate-cutting mode, but also due to a reversion away from the FanMag stocks catalyzed by the Bank of Japan rate hike. As shown here, the utility sector and the real estate investment trust sector, the REIT sector, well, they've significantly outperformed the market in the third quarter so far. Will this trade have legs? Income stocks are not the only stocks that do well amid rate cuts. Indeed, high dividend stocks are only one of the 3 categories of beneficiaries of rate cuts. On the left side of the chart, we also have companies with extreme economic sensitivity, like deeply cyclical steel companies and industrial manufacturers. On the right side of the chart, we have companies with highly elevated valuations reflecting significant growth potential, perhaps electric vehicles or an IPO of a new artificial intelligence company. But just because these 3 categories of stocks are all beneficiaries from Fed interest rate cuts does not mean they all move at the same time. If the Fed is cutting rates because of fear of recession, then the more defensive income stocks are likely to rise first. Not all rate-sensitive stocks move at the same time. If recession fears are present, then rate cuts will see income stocks outperform deep cyclicals and story stocks with a bias towards utilities and healthcare REITs in particular. As economic fears eventually subside, early cycle stocks ought to lift next, typically other REITs like apartments as well as early cycle industries like lumber. Lastly, late cycle movers reflect improvement in the IPO market, which ought to lift story stocks. Switching subjects to the labor and staffing markets, we have seen mixed reviews of the labor market as we discussed back on slide 21. And with presidential elections upon us, it seems there are questions in the media about the quality of the data, for better or worse. Staffing stocks have been under a modest degree of pressure so far this year, as shown in the chart here. The Dow Jones Training and Employment Index has underperformed the S&P by approximately 30 percentage points. While this is not a recession-level problem, it is not a positive year for staffing. While most labor market metrics are lagging indicators of the economy, the Temporary Help Index is actually a leading indicator of the economy. This chart shows the Temporary Help Index over the last 35 years. The index hit an all-time high in early 2022, and since then it has been in steady decline. In prior cycles, once the Temporary Help Index dropped more than about 6% from its prior peak, well, we were in a recession. We're now about 9% below the prior peak, but we're clearly not in recession. The lack of recession mainly reflects the fact that we had an artificially high peak in early 2022 while emerging from the COVID recession of 2020. Still, the trending of softening temporary help continues. If we exceed about a 12% decline, that would put us at recession levels where we started the prior two recessions. So we're not in recession at present, but we may be skirting recession in another quarter or two if the present rate of decline in temporary help continues. Of course, the recent dovish turn of the Fed ought to help, though it does take time for Fed policy to ripple through to corporate hiring plans. Most of the publicly traded staffing companies have seen fairly sharp downward revisions in earnings in 2024, and most have seen stock prices underperforming. Of course, staffing companies frequently specialize in various segments of the labor market, perhaps technology or finance, nursing, drywalling. At present, the lower-paid blue-collar occupations appear to be under more pressure than the higher-paid white-collar occupations. This appears to coincide with consumer behavior, where low-price retailers are actually seeing more pressure than some of the higher-priced retailers. Our read is that we indeed have some level of labor softness in the U.S., a softness that is not at recession level, but that's why the Fed is cutting rates. Of course, again, the rate cuts take several quarters to manifest in improved labor markets, but help is on the way, so be patient. We're now going to shift over to the chip market. One of the most asked questions we get is NVIDIA's success coming at the expense of Intel. As we can see here, this is a chart of the Philadelphia Semiconductor Index year-to-date with constituents ranked by year-to-date performance. As you can see, NVIDIA is leading the pack on the left side, rallying over 130%. But Intel is near the far right, down over 50% in 2024 so far. The last couple of years have been banner years for NVIDIA, but have been a veritable train wreck for Intel, with the stock down over 70% from its 2022 high. At first blush, Intel seems like a textbook case of a fallen angel, a company with a storied history facing new risks that it will eventually overcome with sheer grit and determination. But the fall has been so sharp that there is real fear of obsolescence risk. The table here lists a dozen pros and cons to the Intel story, but our headline from the prior slide basically sums it up. NVIDIA really is gaining at the expense of Intel. NVIDIA GPUs are displacing Intel's CPUs at a budgetary level. Gen AI really can't exist without NVIDIA's GPUs, so Intel's CPUs are a veritable afterthought. While Intel still dominates the high-end gaming market, that market has slowed down noticeably post-COVID. Further, AMD seems to be making inroads into the data center market at the expense of Intel. We do not see a slowdown in NVIDIA's GPU market anytime soon, but the growth rates, of course, will taper simply due to the law of large numbers. Intel stock price is likely closer to the bottom at this point, especially given potential corporate finance deals with a possible spin-off of the foundry business or even a possible buyout. Indeed, Qualcomm has been in the news discussing a possible buyout of Intel just in the last couple of weeks. We do not own Intel at present and do not expect a turnaround in earnings over the next year or so, but we suspect Intel's core CPU business will improve over the next 2 to 4 years and that Intel stock will eventually get traction. Switching to our last topic on microeconomics, crude oil prices. Seems crude oil prices have been persistently weak over the course of the year despite decent economies worldwide. Do we have a supply glut or an overly strong dollar? What's behind the weakness? To add to the mystery of where oil prices are headed, we have conflicting stories. The futures curve on the left is actually suggesting that oil prices are actually headed lower. In fact, long-dated futures are $5-6 a barrel lower than the current spot price. But on the right side, we actually see that oil inventories are actually really quite low, suggesting supply scarcity and possible higher prices. Our read here is that oil is likely to remain in a trading range at around just over $70 a barrel. This assumes no new geopolitical events that could create a temporary restocking-driven surge in prices. Yes, the U.S. inventories are low, and OPEC is cutting supply, yes, but prices are still above pre-COVID levels. Non-U.S. inventories are a little higher, and the futures curve is low for a reason. Oil seems likely to remain in a trading range. Before we conclude, we have two additional slides with top-down and longer-term views. Cedar River does look at equities on a global basis and benchmarks using global metrics. We like the global view, knowing that there have been periods of time when non-U.S. stocks significantly outperformed U.S. stocks. Yet over the last half century, the U.S. stock market has dominated the global market, typically accounting for about half of the world stock market, despite having only about 5% of the world population and about 20-25% of global GDP. Why has the U.S. dominated the global stock market? Well, it's a combination of factors. Right at the top of the list is the U.S. dollar is the world reserve currency. The U.S. also has economic, political, and military strength, but also outside the U.S., many companies prefer to stay private and under the radar, partly to evade taxes, partly to evade regulations, and partly to evade corrupt government officials. Naturally, there have been periods of declining U.S. share. The biggest share loss events usually have been tied to meaningful U.S. dollar weakness and a subsequent path-dependent sequence of events. 1974 to 1983 was tied to going off the gold standard, of course. 2004 through 2013 was kicked off by Gulf War II and the embracing of the new euro. We do not anticipate a reversal in the U.S. share in the near term, though we do retain global positioning in the event that and could move quickly in the event of another pickup in foreign stock markets. We discussed the FANMAG stocks, also known as the FANG stocks, at various points throughout today's presentation, a topic that has risen in nearly all of our video presentations over the last 5 years. But investment themes do change over time. The FANMAG stocks have been the dominant theme for the 2010s and into the COVID and post-COVID eras. But as the chart shows here, the FANG stock theme was preceded by the BRICS theme of 2000 to 2010, and the BRICS theme was preceded by the dot-com tech theme of the 1990s, which was preceded by the Japan Inc. theme of the 1980s, and so on. Investment themes do not last forever. Indeed, the broad investment themes typically change about once a decade. So we're about due for a change. You might say the FANG story is getting long in the tooth. What's next? Hard to say. Perhaps in non-U.S. markets such as India, or perhaps small-cap stocks, they've been overlooked, or perhaps an overlooked sector like an industrials renaissance. We will keep our ears to the ground. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.